Greetings from Miami, Florida. I'm joining you today from our offices in Coconut Grove, where seaplanes, as you see behind me, used to land in the 1930s, approaching Pan American headquarters. Times clearly have changed, but we're still finding exciting opportunities in travel and tourism, which is one of our themes in the portfolio and continues to be an exciting growth opportunity. It's been 5 years since we entered the Australian market with our launch of our strategy through Channel Capital. And we want to thank everybody for tremendous support that we've had through this period. We got off to a very strong start in 19 and 20 with very strong markets. Emerging markets did quite well as you had basically the pandemic rally. But that was followed by a difficult period. Over the past 3 years, you've had basically a war in Russia-Ukraine that has disrupted supply chains. We've had inflation shocks. You've had Fed hikes. In addition, we've had central banks being very austere throughout this period, hiking rates dramatically. We think, though, at this point, those rate hikes and the rate cycle is well behind us. Emerging market central banks have done a great job managing the crisis. Emerging market finance ministers and governments actually have held back in terms of printing money or putting through an enormous amount of fiscal packages like we've seen in the US and Europe and in the UK. And so we think that with the Fed starting to ease monetary policy this year, our strategy is set up to do extremely well. The portfolio trades at 9 times earnings, very cheap valuation compared to the index at 13. The bottom-up growth rate of our portfolios, approximately 25 to 28% earnings growth over the next 3+ years. Very, very strong, much higher than the index. And if you look at the return on capital of our businesses, it's 22, 23%, which is almost double the index. We are GARP investors, as you know, and if you look at the portfolio is set up to do extremely well in terms of the potential upside. Today, we have well over 50% upside to the price targets in the portfolios. In terms of the strategy positioning today, we are overweight China. I was just in China 2 weeks ago with members of our team, Colin, Tianyu. We spent the time seeing many different industries, many different companies, meeting government officials, meeting brokers and advisors. And we came away actually with a positive and constructive outlook for the Chinese recovery. They are doing extremely well in certain areas, such as electric vehicles, renewable technologies, wind, solar. Prices are collapsing as a result of Chinese innovation and production. We're also seeing a big focus on automation. All the companies that we met with, they have an AI strategy. They've invested in and continue to invest in machine learning, which we thought that was a surprise and very different from the market. I think the biggest takeaway was, though, that the property market has stabilized. We're seeing tremendous support for the property developers coming through the banks. We think that clearly is not being recognized in the market. First and second tier cities, actually, real estate prices have stabilized, and we're starting to see traffic pick up. We met with 5 different property developers in 6 different cities, and that is encouraging to see in terms of setting up for recovery. China, as you know, grew about 5% last year, and we think is probably set to grow in the 4.5% to 5.5% this year. In addition to China, being overweight China, the portfolio is also overweight Brazil. Both of these countries, we think, benefit as rates come down in the U.S. And in addition, we do have some exposure to the smaller emerging markets, such as Turkey, Argentina, which are starting to see a recovery, which also have reform-focused government and government policies. The themes in the portfolio, which continues to, as you know, be a growth driver and an area where we look for ideas and where we organize our research, are, as I mentioned, travel tourism, but the largest theme today is actually financial inclusion. When we look at the banks, when we look at financial companies, they're set up to do well as rates come down and as growth picks up. In addition, we have transition materials such as copper. Copper is starting to do well. The supply-demand imbalance in copper remains pretty stark at this point today, and we're starting to see the copper prices reflect that. We also think that materials overall and commodities should do well as growth starts to pick up outside of the U.S. So with that, we do have a positive outlook for the strategy. We would once again like to thank you for your continued support, and look forward to seeing you at Down Under later on this year. Thank you very much.